Raihan Salam, president of the Manhattan Institute, a research and advocacy organization dedicated to keeping America and its great cities prosperous, safe, and free. We've assembled some of the nation's most incisive economic and political thinkers to discuss the future of free enterprise. There's an emerging consensus around the future of free enterprise here in Washington, D.C. In essence, it's that free enterprise does not have a future, or at least not much of one. Critics of free market orthodoxy can be found on the left and right, and increasingly in the halls of power. If the Biden administration has a core animating conviction, it is that the age of neoliberalism is at an end, and that Bidenomics represents a new way forward, a paradigm in which public investment and thoughtful industrial planning will build the economy of the future, and stringently regulated, politically pliant private enterprise will have the privilege of playing a supporting role in meeting consumer needs. Needless to say, Bidenomics hasn't resonated with the wider public. Indeed, the president and his allies largely avoid the term these days, and for good reason. In a recent Echelon Insights survey, 59% of voters cited the cost of living as the biggest challenge facing the country. 85% of respondents told the AP that inflation and rising prices will be a strong motivator for their vote in November. And according to the Harris poll, only 31% of registered voters believe the economy is on the right track. Of course, none of this is to suggest that voters have suddenly become small government ideologues. Even among Republicans, 52% of voters in the most recent general social survey say that rich households should pay a greater share of their income in taxes. That's not exactly encouraging news for those of us who are ardent tax cutters. Doesn't that suggest that things are very different than they were in the Reagan era? Not quite. In 1987, at the tail end of the Reagan presidency, 63% of voters felt that the rich weren't paying enough. That is, at the height of the Reagan era, Republican voters were more, quote-unquote, populist than they are today. We see a similar pattern when it comes to entitlement reform. In 1984, 15% of Republican voters felt that federal government spent too much on Social Security. Again, not exactly a ringing endorsement of austerity. Today, that number has fallen, but it's fallen to 8%. Somewhat lower, yes, which is what you'd expect given the aging of the electorate, but this isn't exactly a revolutionary shift. The truth is that whether we're talking about the Reagan era or the Biden era, most voters, and especially most center-right voters, aren't especially ideological. Indeed, this is one way to make sense of Donald Trump's political rise. No one seriously believes that Trump is a committed ideologue. Rather, his appeal is that he will do whatever works in defense of his constituency. So as we look to the future of free enterprise, the real question is not whether voters will explicitly embrace the economic prescriptions of Mariana Mazzucato or Milton Friedman. It's about which policymakers they'll trust to get the economy moving ahead, to break left-behind communities out of stagnation and decline. The argument that partisans of free market policies ought to make, the argument that is most compelling, is not that their approach is the most philosophically sound. It's that they're calling for sane, sustainable, flexible policies that will actually work to combat sclerosis and stagnation. What we need, in short, is free market realism, not free market ideology. Many of today's most profound political economy challenges, including housing affordability, energy abundance, biomedical progress, even rising geopolitical tensions, call for a renewed focus on unlocking the supply side of the economy. This is just some of what we'll be discussing today. And with that, I'm honored and delighted to introduce our first speaker, a genuine thought leader on the Hill, Representative Patrick McHenry of North Carolina. During Congressman McHenry's time in office, he served in a number of key leadership roles, including his current position as chairman of the House Financial Services Committee. Drawing on his wide-ranging experience, which includes a stint in the executive branch under President George W. Bush and in the North Carolina House of Representatives, Chairman McHenry has played a central role in efforts to modernize America's approach to financial regulation. Please join me in welcoming Chairman McHenry. Chairman, it's been almost 16 years since the global financial crisis, which devastated the American economy. How concerned are you about the prospects for another financial crisis? And what's your assessment of what policymakers in both major parties have done in the years since to foster greater financial stability?
There's always a concern whenever you're in one of these seats overseeing the financial system of the next crisis, or that you don't have enough data or the proper data to measure what will become evident after the crisis. What I do know is that we, through Dodd-Frank, threw a massive amount of resources at preventing the next financial crisis, including creating the Financial Stability Oversight Council, which missed the hole on the bank balance sheets that was evident in March a year ago with the systemic banking crisis that took down 3 banks, but only 3 banks. Seems less systemic in its aftermath. But the Financial Stability Oversight Council didn't see this coming. So no matter how much money you throw at it, no matter how many new government boards you have, you're going to miss what will become evident afterwards. What we can do is build resiliency into the financial system and make sure that there is a clear understanding of bank balance sheets so that investors can see clearly. That's what happened in March, is that investors in December called out what became evident to the broader public instead of investors in March. And the regulators didn't catch it. So clarity to the public, and then third and finally, making sure they have no remit to the public sector, that a bank can fail, and a bank can fail without causing a contagion in the financial system, nor a large crisis otherwise. And I think we can do that through proper regulation and changing significantly what Dodd-Frank foisted upon the American financial system.
Talk to us more about Dodd-Frank and what you see as its excesses.
Well, first of all, you've taken all of our banks, and we now have a banking system that rates those over $50 billion and those under $50 billion as 2 types of institutions. And in terms of regulation and regulatory, practical regulation, the financial regulators in Washington have treated them all the same. So you don't really have a diversity of lending options in the marketplace, which has given us a vibrancy. So imagine a large bank, you come in and you say, well, I'm an entrepreneur, I have these 3 contracts, I'd like to buy my 4th piece of equipment, okay? And the large bank says, we really don't have time for this type of lending. It's a little too risky for our box checking exercises we have to do for our regulators. And it used to be, pre-financial crisis, you can go to a small bank and they say, well, tell me about these contracts you have. Oh, it's right down the street. We know these institutions. We know you have a 2-year run for these contracts because we've verified it with these folks. We'll take a risk with you. We'll take a walk with you. So it's more venture-style lending, private equity-style investment that banks used to do, and they cannot do because of regulatory overreach. The public markets, large banks, they'll adapt to the regulatory structure. It does have this large macro effect on lending, but they can adapt to a few more lawyers. So the smaller institutions cannot, and that's what's been the most harmful bit of Dodd-Frank.
You see the banking sector right now as excessively consolidated, and you want to see new entry.
What I'd like to see is real competition. And if you're denied a loan at a $100 billion bank, you're probably going to be denied that same loan at a $10 billion bank and at a $1 billion bank. Before you go back, those 3 institutions may have different risk profiles, and they would have the adaptability to take different types of risk based off of knowledge and practical understanding. That is less so the case today. So while we have a significant number of banks in this country, it has been grossly consolidated over the last 40 years in a significant way, born heavily out of Washington regulation, and the disproportionate set of consolidation has occurred post-Dodd-Frank because of regulatory costs. Then you have our current financial regulators that look at competition law in a very artful and new way. And by new way, I think new math, I think a gross concoction that somebody's trying to sell you because they have an overage of celery in the kitchen, right? And so they're trying to foist on the body politic something that it does not want. So I've gotten ahead of myself with the celery comment, but my point here is that we need to get back to a traditional understanding of competition law, not this administration's novel approach to competition, whereby no one wins. No one wins, and and so they've had this very artful look of what they don't like in the marketplace, not competition law. If this administration wants to oppose consolidation of financial institutions or to technology companies, they can do that through policy. They don't need to mask it in competition law. That's not borne out in the traditional economics of competition law.
Fascinating. So part of it is a question of excessive consolidation, but you want to use the right tool to address that. And also another issue is differentiation, making sure that we have financial institutions that are meeting the need of the wide breadth of different American business enterprises.
So some reasonable consolidation for banking could make sense, right? So that you actually have more competition. Right now, half of the households in America have, close to half of the households in America have an account with one bank. Is that absurd? Yes, it's absurd. And it's a direct result of those large financial institutions being benefited by Dodd-Frank and driving consolidation at the elite highest levels, and then decimating these financial institutions where they can't even consolidate to compete up with those largest financial institutions.
You've been a champion of dynamism and innovation in the financial sector, and one area where there has been considerable innovation, but also considerable controversy, is the digital assets ecosystem. Can you walk us through what it is you were trying to accomplish with the Financial Innovation and Technology for the 21st Century Act?
Sure. Right now we have this thing called crypto, and I'll try to put this in building blocks so you see where I'm going. Crypto. Crypto is, think Bitcoin, the Bitcoin white paper, and what Satoshi Nakamoto established in the Bitcoin white paper. You have a blockchain infrastructure, and the key to that blockchain infrastructure to see your information, protect your data, is a key. Your key has some value to it. That key we now call crypto. That would be Bitcoin. That would be ETH for the Ethereum network, Solana, right? And so you have this infrastructure, and you have a key to the infrastructure. The key has some value. We have a number of people that are trading that as a financial instrument because a key does have value to a larger network, obviously. Now, what is crypto and what is a digital asset has no federal definition. So we have over 10,000 coins being offered in novel concepts, much of which is fraud. No federal definition of this, no legal frame for establishing a property right or an ownership right to it, no means of exchange. And so what I've tried to establish with legislation through FIT 21, working with Congressman French Hill, who helped me, and we designed this bill together with Congressman Glenn Thompson and Dusty Johnson on the Ag Committee. We established what is the Securities and Exchange Commission's proper role here on market structure. What is the Commodities Futures Trading Commission? What is a digital commodity? What is a digital security? And we have this dividing line. This is what happened in 1933 with the establishment of the Securities Act and the Securities Exchange Act 33 and 34. And this is what we need for this new architecture around digital assets. A definition, a means of exchange, clarity under law. What we're trying to do with this legislation, which got bipartisan votes out of the House, over a 2/3 vote of the House of Representatives, with 71 of my Democrat colleagues joining almost all Republicans. What we established here is a clear set of rules of the road that is not dissimilar to what the Europeans have established, not dissimilar to what they've established in Japan, Singapore, and even Hong Kong. We're trying to catch up to where the Europeans are in this new cutting-edge technology. When was the last time we're trying to catch up with Europe on technology? Not in this century, not in the last century. It's been a very long time where we're behind Europe on innovation and innovation policy, but this is one area where we are because we haven't had clarity of law. And I think given how wide this vote was in the House, it established two things. One, post-financial crisis politics are not the same. This is not big bank, little bank policy. It's not what the progressive left, the populist progressive left is trying to do with financial policy. So those politics are gone, number one. Number two, crypto's here to stay, and it is bipartisan. With those two things, that gives us an opportunity to legislate, not just in the House, but through the Senate, and get a bill signed by the president.
What do you see as the potential implications of a rising embrace of digital assets for financial stability? Do you see it as potentially a tool that's conducive to fostering greater stability? Because of course, I think there's a widely held view among skeptics that it's not. To call it a cryptocurrency, to call it a currency, I don't think has the right moniker. This is the underpinning of the next set of internet technology, and we'll see the benefits of digital assets in crypto for the next 20, 30 years. In many ways, the concerns of AI and deep fakes can be answered through digital assets and tokenization. Those things we can establish digital identity in a very resilient way and ward against AI deepfakes. And I think the pairing of those two technologies it will bring us a level of stability that we will greatly need in this really changing world of AI deepfakes. Fascinating. Mortgage rates have increased sharply over the past few years, pricing millions of families, especially younger and working class families, out of home ownership. Last fall, mortgage applications reached their lowest levels in 28 years. Talk to us about the role of Freddie Mac and Fannie Mae and the role they've been playing in the housing market and how you think it ought to change, if at all.
Well, first, the great work left undone is fixing the problem the Bush era decision to nationalize Fannie Mae and Freddie Mac. These were quasi-governmental corporations. They were both public companies and benighted institutions here in Washington that got very special treatment. And then they were what ignited the financial crisis in 2008, 2009. We've not fixed the problem. These two are now not quasi-public sector, they're, not quasi-private sector, they're fully public sector institutions with special privileges to pay people more. And with over $1 trillion of assets, this is the great work left undone in public policy. For my chairmanship, I have 3 terms to lead the committee. As a Republican, we have term limits. Term limits have benefited House Republicans greatly. We have competition. I've got a number of great Republicans competing for my seat for next Congress, and that's a very good thing. I think the term limits policy for House Republicans has been a great benefit. Now, in this circumstance, it doesn't benefit me because I had 2 terms as the ranking member and now 1 term as the chair. I knew the rules going in. I'm honoring and respecting those rules. And that's a component of why I'm retiring from Congress. I've had my run over 20 years and 6 years of leading the Republicans on the committee. If I had more time, housing finance reform would be a top agenda item. But it will take time, and it will take an administration that is interested in doing something and fixing the problem. And fixing the problem in a way that is sustainable for the American economy over the long term, which means you have to have a balanced approach. And in order to touch Fannie and Freddie, you have to have interest from both parties in order to legislate here. I do think it's possible, but without the administration deeply engaged, it's going to be a hopeless task. but it needs to be done. Absolutely needs to be done, especially with Fannie and Freddie having ambitions into new product offerings that get away from safe and sound practices and get back to the pre-financial crisis bad ways of Fannie and Freddie.
So you're referring to the advent of this proposal for a home equity product from Freddie Mac?
Yes.
Your view, I'm curious if you think the private credit markets are going to be impacted by the advent of such new products.
Well, it surely would. If you have a government agency competing with you, you usually lose because private sector decisions and public sector decisions with money don't have the same level of resiliency.
Indeed.
I do think it's problematic. I also think it's highly risky for Fannie and Freddie to get into these offerings. Being in a first loss position is greatly different than being in a second or third loss position, and most of their products are in a second loss position. They're putting themselves through using the taxpayer dollar in this first loss position, which is not its place.
Fascinating. It does almost seem akin to kind of a sweeping socialization of a huge swath of the housing market, which has all sorts of implications down the road.
It is the further socialization of the housing market. The fact that we have the largest set of assets in America are owned by a government entity through Fannie and Freddie, or securitized through those government agencies shows that the housing marketplace is greatly socialized today. And any more than that will be a great risk to the taxpayer.
You've described next year's fiscal cliff as such a juicy, crazy legislative prospect, it's almost worth sticking around for. Sadly for us, you won't be there. But how would you advise Republicans in the next Congress on how to approach the debate over extending the Tax Cuts and Jobs Act?
You have a confluence of two events occurring at the end of 2025. You have all the ramp up of the Biden large-scale spending programs of his first 2 years in office, first 18 months in office. Much of that expires. The health care subsidies in particular expire at the end of 25. The Obamacare, the sweeteners they put in place. So at the end of 25, you have a large fiscal event on the spending side. Some of those provisions that Biden put in place are tax policy and subsidies through the tax code. Those expire at the end of 25. You also have the individual rates and the small business rate, which I would argue is our third tax system in the United States. You have the corporate rate, you have the small business rate, and you have the personal income rate. And so the small business and personal rates expire. This puts a huge pressure point on Congress to act on tax policy. But the additional pressure point of these large-scale subsidies and large spending programs. And so you have a confluence of a fiscal cliff, unlike anything we've seen in American history. So the dollar amount is going to be extraordinary. I think the first thing Congress has to do is separate the two issues. You can have two reconciliation bills going into next Congress if acted upon appropriately. So you can deal with tax policy first, and you can deal with these additional fiscal items second. It will be more difficult to deal with the trade-offs necessary in the fiscal question than it will be in the tax question. In the tax question, the hottest issue then for the Tax Cuts and Jobs Act and today is this question of the SALT deduction. What is sufficient? We have a $10,000 cap. Is that sufficient? Well, it's clearly not sufficient for certain states. And certainly certain municipalities within those certain states.
I can't imagine which municipalities you're thinking of.
I don't want to be too specific. The reason why we were able to pass the Tax Cuts and Jobs Act that touched SALT in such a serious way was that we had the votes to do it. And everyone hates to hear this. I care deeply about policy, but I make policy in the midst of politics. And I want 100% of my policy that the votes will bear. And I'm willing to trade in order to get things passed. And that means I don't always get 100, I actually never have gotten 100%. For the Tax Cuts and Jobs Act, the only reason why we're able to do the SALT deduction the way we did is because we had the votes to do it. I think in the next Congress, we will not have the votes to do it the way we did in the Tax Cuts and Jobs Act.
Regardless of which party is in the majority in the House.
Correct. The Democrats have a much more significant problem on SALT than do Republicans. But Republicans, if you have a problem, and let's say you have it's just the practical thing in the House of Representatives, you have 435 votes. You have 218 votes for Republicans, and you have 217 for Democrats. And you say, well, but we only have 5 people who care about SALT who are Republicans. Well, that's actually 500% more than you need.
Right.
To address the problem. So I believe that we'll have to address SALT in a much more balanced way for members of our party who happen to represent very southern piece of a very important state. So, but that's not even the best example of the modeling of this stuff, because you have Illinois, you have California, you have certain municipalities across the country that are Republican represented that have a SALT issue, and that models out quite differently. So I think to deal with the tax bill, you should be able to get that going quickly in 2025 with a Republican House, Republican Senate, and a Republican in the White House. That would unlock the tax question without having to address the fiscal question, which will be much thornier and much more challenging, given the nature of those subsidies and how they affect different districts and states across the country.
Are there pay-fors?
Including clean energy in particular.
Are there pay-fors that you can imagine conservatives and moderates in the House coalescing around in order to accommodate, let's say, a somewhat more capacious or generous approach to SALT? Republicans in the House have talked about the idea of rolling back many of the green energy subsidies in the Inflation Reduction Act. Again, dicey if you're trying to cobble together a bipartisan majority, but I'm curious where you see some opportunity. And again, you're not running for re-election, right? So
yeah, I'm liberated here. I would tell you that we tried to address some of these clean energy tax provisions, subsidy provisions that Biden put in place last year, the early 2023. And my Republican leadership in the House found it a very challenging thing to touch.
To unify the conference.
Yes, because we are representatives. And if you are going back and telling your people that you directly put the screws to them, they don't like it. And so when you're talking about clean energy, let's talk solar, wind. The largest solar states in the country are Republican-led states. And the investment in solar is disproportionately in Republican districts in those Republican states. So the idea that you're going to do a full sweeping reassessment of green energy tax policy and be able to do it like this, it's going to be quite a challenge for the next Congress.
Fascinating. So you could imagine that being shaved, but no kind of wholesale reversal.
Correct. And so I think there are other more interesting pay-fors you can do in tax policy, and the question is just whether or not the votes will be there to bear that. That's why I think you have to separate the two things, the tax policy from fiscal policy in those subsidy questions. Because you can do a tax extension through the Tax Cuts and Jobs Act without getting into some of the thornier issues around green tax credits.
Chairman McHenry, this past October, you served as Speaker pro tempore during a very tumultuous time in the House. By all accounts, you did a masterful job of dealing with an exceedingly difficult situation. Is your sense that the divides within the House GOP conference are driven by ideological differences, or is it more a function of clashing personalities and political interests?
Well, those are two of the three reasons. The third reason is that you have a narrow Republican majority in the House, and Democrats in charge in the White House and Democrats in charge in the Senate. And so you have a razor-thin majority in a Democrat Washington. It's a tough environment. It's a tough environment for a group of seasoned veterans to deal with, much less House majority that is a majority of the current Republicans in the House had not served in the previous Republican majority. So that muscle memory for what you do and expectation setting is not there. This was our challenge in 2011, taking over the House, and we had the same situation, where expectations were sky high of what we could do with 1/2 of 1/3 of government. And I thought we'd had a better set of expectations this Congress. We still have excessive expectations for what we can achieve this summer legislatively. In particular, passing all 12 appropriations bills, when the Senate has no plan to do that. And regardless of what we do in the House, the presidential election and the election in November will dictate whether or not we have a spending bill for the rest of the fiscal year done in lame duck, whether or not we're even going to appropriate fully this Congress. So the expectations were not properly set. The opening week of Congress should have been the expectation setter. We'd worked intently to set those expectations of what we're aiming for with the fiscal negotiations for the debt ceiling, how we're going to operate the House, what the investigative priorities were going to be in committee, and all those things were hashed out in that first week of January in a very public way. And Speaker McCarthy led a great dynamic effort in dealing with dissidents, bringing them together and saying, here are our objectives, here's how we're going to operate. And he fulfilled all of those pledges, including in the debt ceiling negotiations, including in what we prioritized for appropriations, how the weaponization of government operated and what the Judiciary Committee would focus on and the Oversight Committee would focus on. All those things were laid out in the first week of January. And the Speaker honored every bit of those commitments and had success. Success with the debt ceiling negotiations, success with all the legislative proposals that came through the House conference, and whether that's immigration reform, tackling energy policy, a number of the key priorities of the conference. And he was undone by passing a continuing resolution. That was not what I expected for the year. Of the risk set that I thought through, by the way, the risk set didn't include what would happen to me. That was not on the bingo card. But that risk set, I had said in December to the Speaker, there are three things, Speaker McCarthy, in December 22. The debt ceiling, FISA, and then the full year government funding. Those are the big three risks for his speakership. He succeeded with the debt ceiling negotiations. Congressman Garrett Graves and I, he tasked us with negotiating with the White House. We brought back a proposal, and he managed that so very well, saying to the president early on, his first meeting, let's just negotiate this. Let's get this out of the way. There doesn't need to be drama. And the White House finally caving when they'd said they would not negotiate with us. They caved. And so the Speaker had the upper hand in the negotiations because he was more reasonable than the president and the president's team. We got a negotiated agreement to raise the debt ceiling with the largest spending cuts in American history attached to that debt ceiling increase. It got a 2/3 vote of House Republicans, 2/3 vote of House Democrats. We've never had a debt ceiling increase in my 20 years in Congress that was like that. Now, those spending cuts, we can get to this about our debt and deficits, will be a pebble dropped in the ocean in comparison to the problem that we have. But yet still, it rates as the largest deficit reduction package Congress has enacted ever. And it will still be rated as a pebble in the ocean for the challenges, the fiscal challenges we had. We also, then to September, the Speaker had a continuing resolution. We passed it with a 2/3 majority, and a majority of Republicans voting for that. And then that's what a few went after the Speaker and voted with all the Democrats to oust him. Unheard of. But we have a provision in House rules that is a continuity of government issue. And this is thought of post 9/11, right? And it was a continuity of government provision that if there was a mass casualty event in Congress, that we could still function, according to the Constitution. It was not thought of as a political suicide event, right? The idea was something bad happened, we were in a bunker somewhere, and it's a remnant of Congress, and we quickly make the decision of who the Speaker is. It was not thought of that it would take 23 days to resolve that issue. And so when the Speaker asked me, would I do this? I said, certainly. He said, well, there's just two things you have to do. You have to set the time of the election for House Republicans, and you have to set the time for us to vote on the House floor. Just two things. You only have to do two things, right? And so I said, certainly. And then by the end of the first day, it was clear that it was going to be much more complicated. More complicated than me driving the family station wagon to work that day and coming home in an armored vehicle, which was complicated enough. Pretty funny for my 2-year-old and my 6-year-old. They thought it was great. The 9-year-old's a little embarrassed. And I had the feeling of both of them. Kind of cool, kind of embarrassing. But those 23 days were a huge challenge for House Republicans and really showed our divide and our lack of consensus on the type of leader we wanted. But we made the decision, and it was nasty, it was rough, and we made a decision. We were going to have Mike Johnson as Speaker of the House. And getting to that decision was rough, absolutely rough. But he came to the House floor without a dissenting Republican vote. That was a significant thing. And it showed that he's the right person at the right time to do the job. And he's shown that he can perform. We got the key priorities. Got a little flack for what I said about him in January, because what I said in January is get on with the deal making. You can land big deals and be an effective Speaker. We've set the spending constraints according to the debt ceiling. Go fulfill it with a full year spending bill. Reauthorize FISA. Pass the supplemental. All these things have 2/3 support in the House, and they got 2/3 vote of the House. And I think Mike Johnson's performing well, and he's performing as a Reagan conservative should perform. And I think he's showing that he's got the chops for it, which probably bodes well for him next Congress, frankly, and being able to lead this raucous group for another term.
Chairman McHenry, big picture question for you. You were talking about this just now with the unusual way the House is operating right now, oftentimes with these peculiar bipartisan coalitions. But you also mentioned another bipartisan coalition you built around digital assets. Mm-hmm. When you're thinking particularly about the question of free enterprise, about free markets, do you see, as you leave the House, the possibility that there will be a kind of innovation-forward, market-friendly coalition that can be cobbled together with folks from both political parties? Or is that just a pipe dream?
No, I think this vote on our market structure bill, FIT 21, shows that there is an innovation-forward group that are willing to go stick their neck out and take a vote to further innovation in America and make sure that we have the edge. I think that's a welcome thing. That vote coalition among the Democrats was fascinating to me. 71 Democrats have voted for FIT 21. You can't say that these were blue dogs. You can't say they're progressives. You can't say they're in this caucus or that caucus. They touched every caucus that the Democrats have, including the Democrat whip and the Democrat conference chair, Pete Aguilar, as a policymaker from California, saying, no, we want to own technology and innovation. And showing that you can be firmly in the midst of your party and be innovation forward, including Speaker Nancy Pelosi, who understands the value of technology and innovation, being the Congresswoman from San Francisco. So to see that mix It doesn't break down in terms of ideology. It doesn't even neatly break down based off age, although that is a component of it. Of more longer-term Democrat colleagues aren't as innovation forward as the newer members of their caucus. But it shows that they are interested in America keeping its edge. And we have to foster that. And we have to make sure that for us to compete against our great adversaries globally, we have to be better versions of ourselves. We have to double down on who we are, open society, rule of law, speech rights, all those things that have given us the great capacity over the long term through the free economy to develop the best products and to find that fit. And we've been able to outcompete everyone over the last century based on those principles. And we have to double down on those efforts, not try to be a pale comparison to like the CCP. That's a really bad idea. But to be better versions of who we are historically, that's how we win. That's how we win the next century.
Please join me in thanking Chairman McHenry.
Thanks, Ryan.
Thank you very much.
Thank you.
Really appreciate it. Hope we can talk again.